The next learning objective is preparing a payroll register. So here's an example of a payroll register. Looks like the name of the company is travelwithus.com, so they must be a travel agency. And so when you work in payroll, you're going to create a payroll register every time you have a pay period. And what it does is it contains information about the employees that were paid during that pay period. So in this case, the pay period looks like it's from October 13th through October 26th, and the pay date was October 29th, 3 days after the end of the pay period. So starting with the far left column, looks like we have 5 employees: Stephanie, Catherine, Julia, Annie, and Harold. The next column is our W-4 allowances. That means the marital status and the number of allowances that each employee is claiming. This comes from the employee's W-4. The S stands for single, M stands for married. The next column, we've got prior earnings year to date. This means the employee's total earnings for the year before this pay period. Next, we have our column for salaried employees. Looks like we have only 2 employees that are salaried, Catherine and Julia. And then the next set of columns is the regular pay. In other words, the hourly employees pay for the first 40 hours per pay period. And since this pay period is 2 weeks long, the maximum number of hours for regular pay would be 80. So the rate is the hourly rate for these hourly employees, and then the regular amount is just calculated by taking the hours times the rate. Then the next 3 set of columns is our overtime information. Looks like Stephanie worked 4 hours of overtime, and her overtime rate is 17.10. That's calculated by taking her regular rate, $11.40, and multiplying it by 1.5. Now you may be wondering, how can she have overtime hours if she only works 78 hours? Well, in one pay period, she must have worked 44 hours. And then the overtime amount, of course, is calculated by taking the hours, the overtime hours, times overtime rate. Then we have our gross pay column, and then we have our current earnings year to date. Current earnings year to date is the prior earnings year to date plus this pay period's gross pay. And of course, getting back to the gross pay, that's calculated by taking either adding up their salary or their regular pay plus their overtime pay. So this is page 1 of the payroll register. There's a second page. So here's the second page. The first set of columns, notice, are called taxable earnings. Now remember, this is not the tax, but these are the wages subject to these particular taxes. The first set of taxes is FUTA SUTA. They're both in the same column because they both have the same wage base, $7,000. So according to the FUTA SUTA column, only one employee has gross pay that is taxable for FUTA and SUTA, and that's Annie. So the other 4 employees, Stephanie, Catherine, Julia, and Harold, must have had prior earnings higher than $7,000. So I'm going to go back to the previous slide and let's check to see if their prior earnings were greater than the $7,000 wage base for FUTA SUTA. So here's the prior page, and notice under prior earnings, Stephanie's prior earnings are well above $7,000. Same with Catherine, Julia, and Harold. And notice Annie's not over the $7,000 wage base. That's why on page 2 of the payroll register, which is right here, shows that only Annie has any gross wages that are subject to FUTA and SUTA. And then under the taxable earnings, we also have a column for ASTI. So any payroll tax that has a wage base, you're going to need a taxable earnings column for them just to calculate how much of their earnings for this pay period is subject to those taxes. Next, we have a list of 5 deductions: FIT, SIT, OSTI, Medicare, and then medical insurance. Then we have net pay. Net pay, of course, is the gross pay from the previous page minus the 5 deductions. Then we have the check number, and then we have something relatively new called expense account charged. So this company has 2 departments: travel scheduling and administration. So when you are in charge of a department, such as travel scheduling, you are given a budget, like maybe $100,000 for a year, and your goal is to not spend more than $100,000 during that year. And things that you are spending your money on include the gross wages of your employees. So in the travel scheduling column, it looks like Stephanie is part of the travel scheduling department, as is Julia, Annie, and Harold. So these numbers, like Stephanie's 957.6, that represents their gross pay. And again, this is just basically for budgeting purposes. And it looks like we've got only one employee in the administration department, and that's Catherine. So the payroll register is pretty straightforward. The only thing that students sometimes screw up is in the taxable earnings columns. Sometimes students try to put the tax in there instead of the taxable earnings. And then in the expense account charge columns, travel scheduling and administration, sometimes students accidentally put in the net pay, but we don't want the net pay. We want the gross pay to go in these columns. And then finally, some companies will do 2 payroll registers, one for hourly employees and one for salaried. The one that we just saw combines both hourly and salaried employees. And that's it.